September 1998. A hedge fund with just $4.8 billion in capital is sitting on positions tied to more than $1 trillion in derivatives, built on borrowed money, reinforced by elegant equations, and protected by absolute faith in mathematics. On paper, the risk looks controlled, diversified, almost boring. In reality, every assumption depends on one fragile belief: that markets will keep behaving the way they always have. Then the market stops behaving. Spreads widen. Liquidity disappears. Margin calls arrive faster than answers. And suddenly the smartest people on Wall Street realize the problem isn't bad math. It's leverage meeting fear. By the night of September 23rd, 14 of the world's largest financial institutions inject $3.6 billion into one hedge fund, not to save it, but to stop its collapse from tearing the entire system apart. How did a fund that was never supposed to matter end up holding Wall Street hostage? The most dangerous time in finance is rarely when people are scared. It's when nothing seems wrong. When markets feel calm, predictable, and safe enough that people begin to believe risk has finally been tamed. That was Wall Street in the late 1990s. Inflation stayed quiet. Markets moved gently, and crises felt like distant memories rather than real threats. Money no longer felt fragile. It felt engineered, optimized, and under control. If prices moved, they moved politely, the way models said they should. In that environment, confidence didn't arrive with a bang. It crept in slowly. And with confidence came boredom. Traders weren't asking how to survive the next crash. They were asking how to make more money from a world that refused to shake. This was the moment when a firm with a long name and a simple promise stepped into the spotlight: long-term capital management. Later, everyone would shorten it to 4 letters. But the idea behind it was easy to grasp. Markets may wander in the short term, the firm believed, but over time, prices always drift back toward normal. If two things look almost the same, they shouldn't stay priced very differently for long. If they do, that gap is temporary. You buy the cheaper one, sell the more expensive one, and wait. No bold predictions. No guessing the future. Just patience, discipline, and math. The people behind this firm didn't see themselves as gamblers. In their minds, they weren't betting on markets going up or down. They were betting on the world staying reasonable. And history seemed to back them up. For decades, prices had moved apart and snapped back together again. Volatility came and went, but order always returned. Because those price gaps were small, the profits were small too. And that's where a quiet decision changed everything. If the margins are thin, you simply scale them up. In finance, scaling usually means borrowing. Borrowing money isn't complicated. It's like turning up the volume on a speaker. At low volume, the sound is clean but barely noticeable. Turn it up, and the room fills with noise. But turn it too high, and the system starts to distort. Long-term capital management borrowed heavily, not in a way that looked reckless at first glance, but in a way that felt controlled and systematic. Small price movements, multiplied again and again, became meaningful profits. As long as prices behaved, the machine ran smoothly. There was another belief underneath all of this, so familiar that it barely felt like an assumption at all. The belief that markets are liquid, that if you ever need to sell, someone will always be there to buy. Maybe not at the perfect price, but close enough. There is always an exit. This belief works beautifully in calm times. It feels like a law of nature, like gravity. You don't question gravity until the ground suddenly disappears. What made this firm dangerous wasn't just borrowing, or intelligence, or confidence. It was scale combined with sameness. The firm didn't make one big bet. It made many smaller bets across different countries and instruments, all tied together by the same invisible thread: the assumption that markets would remain calm, rational, and liquid. As long as that assumption held, everything worked. Returns arrived steadily. Volatility stayed low. Banks felt comfortable extending credit. Counterparties trusted the firm. Positions quietly grew larger. Not because anyone felt reckless, but because nothing seemed wrong. And that is the trap. When success looks boring, people stop asking uncomfortable questions. When models keep working, no one wants to imagine the day they don't. The problem wasn't that long-term capital management misunderstood the past. The problem was that the future was about to stop behaving like the past. And the firm had built everything on the idea that it never would. Once the machine started working, it didn't just work. It impressed people. Long-term capital management didn't explode onto Wall Street with dramatic headlines or flashy promises. Its success arrived quietly, almost politely. Month after month, the fund delivered steady profits. No wild swings. No panic. Just numbers that went up with unnerving consistency. This was exactly what Wall Street loved. Anyone can make money in a raging bull market. That's luck. What impressed banks and investors was how calm the returns looked. While other funds jumped up and down with the mood of the market, this one seemed immune. It didn't chase trends. It didn't guess headlines. It simply harvested small differences. Again and again. Like a machine built to mint confidence. And confidence spreads faster than fear. Banks began offering more credit. Counterparties became more comfortable trading larger amounts. Each successful trade made the next one feel safer. Each calm month made the model feel more proven. The fund didn't need to sell its story aggressively. The numbers did that job for them. This is how booms often begin. Not with euphoria, but with reassurance. As the positions grew, something subtle happened. The fund didn't feel bigger. It felt smarter. Every new dollar added to the strategy seemed to confirm that the system worked. When profits arrived, they didn't spark celebration. They sparked expansion, more trades, more markets, more borrowed money. None of it felt reckless. It felt logical. After all, if a strategy works at a small scale, why wouldn't it work at a larger one? If small price differences always close, then larger positions simply mean larger rewards. The logic was clean. Too clean. What made this period dangerous wasn't greed in the cartoon sense. It was comfort. The kind of comfort that comes from repetition. When the same thing works again and again, people stop imagining alternatives. Risk doesn't disappear. It just fades into the background. There's a moment in every financial boom when questions quietly change. Early on, people ask, "Does this work?" Later, they ask, "How big can this get?" That moment arrived quickly. The fund's trades expanded across countries and markets. Government bonds, interest rate agreements, instruments that looked boring enough to be safe. Each one relied on the same basic idea, that price differences would narrow, that markets would stay liquid, that history would continue behaving like history. What investors and banks didn't fully appreciate was how tightly these positions were connected. On the surface, they looked diverse. Different countries, different assets, different trades. But underneath, they all depended on the same environment. Calm markets, predictable behavior, order. As long as that environment existed, the strategy looked almost magical. Returns stayed steady. Volatility stayed low. Confidence hardened into belief. And belief invites imitation. Other institutions noticed. Similar strategies spread quietly across Wall Street. Different firms, different names, but variations of the same idea. Small gaps, big leverage, calm markets, easy money. This is where the boom stops being about one firm. When many players rely on the same assumptions, the system itself becomes fragile. The exits don't get wider. They get narrower. Everyone believes they can leave whenever they want, because no one believes everyone will want to leave at the same time. The irony is that the fund's success made the world more dangerous, not safer. Each calm month encouraged more borrowing. Each steady return encouraged more confidence. Each new position increased the size of the eventual problem. By the time anyone thought to ask whether this growth was sustainable, the question already felt outdated. The model had worked for years. The markets were calm. The profits were real. What could possibly go wrong? Every financial collapse looks obvious in hindsight. At the time, it never does. When long-term capital management was at its peak, there were no sirens, no headlines screaming danger, no dramatic moment where someone stood up and shouted that the system was about to break. The warning signs didn't arrive as alarms. They arrived as inconveniences. Small ones. Markets began to feel slightly less cooperative. Price differences that used to close quickly started lingering a bit longer. Trades that normally felt routine required more patience. Nothing catastrophic. Nothing that justified panic. Just enough friction to be annoying. This is how cracks usually appear. Quietly. Around the world. Stress was building in places most investors preferred not to look at too closely. In Asia, financial turmoil had already shaken confidence. Then, in the summer of 1998, a far bigger shock landed. Russia defaulted on its domestic debt. To most people on Wall Street, this didn't feel like a world-ending event. Russia was seen as messy, distant, and contained. A problem for someone else. But markets don't care about geography. They care about fear. Investors everywhere began doing the same thing at the same time. They rushed toward safety. Government bonds from the strongest countries. Cash. Anything that felt solid. Everything else, even assets that had always been reliable, suddenly looked suspicious. This shift changed the rules of the game. Instead of prices drifting back toward normal, they moved further apart. The gaps that long-term capital management expected to shrink began to widen. And the wider those gaps became, the more pressure built inside the fund. Borrowing had made the profits louder. Now it made the losses louder too. Banks and trading partners started asking uncomfortable questions, not because they wanted to cause trouble, but because they needed reassurance. Positions were marked lower. Collateral requirements crept up. Requests for additional cash began arriving. Margin calls didn't come all at once. They came in waves. Each one could be handled. At first, but something more dangerous was happening beneath the surface. The belief in easy exits was fading. Liquidity, the comforting assumption that someone would always be there to buy, began to feel less reliable. Markets were still open, but they were thinner, jumpier, more nervous, and nervous markets behaved differently. Selling one position started pushing prices down more than expected. Selling a little revealed how fragile prices really were. The fund wasn't just reacting to the market anymore. It was starting to move the market. That realization was unsettling, because once a firm understands that its own actions can make losses worse, every decision becomes harder. Sell too much, and prices collapse. Sell too little, and losses keep growing. Wait too long, and counterparties lose confidence. This is the point where confidence quietly flips. What once felt like control begins to feel like exposure. Inside the firm, the mood changed. Calm calculations gave way to urgent conversations. The numbers still existed, but they no longer felt abstract. They felt personal. Outside the firm, the tone shifted too. Banks didn't panic, but they paid closer attention. Credit lines were still there, but they came with questions attached. Trust was no longer automatic. It had to be renewed. Daily, the cracks were now visible. Not enough to bring everything down, but enough to make one thing clear. The world was no longer behaving the way the model expected. Collapse rarely arrives with a single dramatic moment. It arrives when options disappear. By late August of 1998, long-term capital management was no longer trying to make money. It was trying to survive. Positions that once felt elegant now felt heavy. Every movement in the market pressed harder against the firm, and every attempt to adjust made the pressure worse. The problem wasn't just losses. It was timing. The fund needed to sell assets to reduce risk, but selling pushed prices down. Pushing prices down triggered more losses. More losses triggered more margin calls, and more margin calls demanded more cash. It was a feedback loop, tightening with every turn. This is what leverage looks like when it turns against you. Not sudden, not explosive, but relentless. Inside the firm, days blurred together. Calls with banks stretched late into the night. Spreadsheets were updated again and again. Not to plan growth, but to calculate damage. Every decision carried consequences, and none of them were good. Outside the firm, concern was turning into fear. Banks began to understand something unsettling. Long-term capital management wasn't just another client. It was deeply entangled with the system itself. If the fund was forced to unwind its positions quickly, it wouldn't just hurt the firm. It would flood already nervous markets with selling pressure. Prices would collapse. Liquidity would vanish. Losses would spread. And everyone knew it. This is the moment when the story stopped being about one hedge fund and started being about the entire financial system. The question was no longer whether the firm could survive. It was whether the market could survive the firm's failure. On September 23, 1998, the Federal Reserve Bank of New York stepped in, not as a rescuer, but as a coordinator. It gathered the largest banks in a room and made the situation plain. No speeches, no heroics, just arithmetic. If long-term capital management collapsed in a disorderly way, the damage wouldn't respect balance sheets or reputations. Everyone would pay. Maybe not equally, but painfully. 14 financial institutions agreed to inject $3.6 billion into the fund, not out of kindness, not out of loyalty, out of self-preservation. This wasn't a government bailout. No taxpayer money was used, but it was still a rescue, arranged under pressure, designed to buy time and allow positions to be unwound slowly. Instead of detonating all at once, the firm lost control. Management was sidelined. Decisions were now about containment, not ambition. The goal wasn't recovery. It was preventing a chain reaction. Markets steadied, not because confidence returned, but because the immediate threat had been neutralized. The fire had been contained before it could jump buildings. But the damage was already done. Long-term capital management was finished as an independent force. The idea that math alone could tame markets had been publicly humbled. The smartest people in the room had learned a lesson the hard way. Models don't fail quietly. They fail when the world stops cooperating. What made this collapse unsettling wasn't the size of the losses. It was how close the system had come to breaking, without most people ever realizing it. There were no crowds in the streets. No flashing headlines in real time. Just a quiet meeting, late at night, where the financial system admitted how fragile it really was. The fund didn't collapse with a bang. It collapsed with a phone call. When the immediate danger passed, the world didn't celebrate. It exhaled. Markets didn't rebound out of joy or renewed faith. They stabilized because the worst outcome had been avoided. The system had bent, not snapped. And that distinction mattered more than anyone wanted to admit. Long-term capital management survived in name only. It never returned to its former influence, never regained its aura of brilliance. The firm was slowly dismantled, positions unwound, ambitions erased. What remained was a case study, passed quietly from meeting rooms to classrooms, often reduced to a technical failure. But the real lesson wasn't technical. The real lesson was human. This episode forced Wall Street to confront an uncomfortable truth. Risk doesn't disappear just because it's sliced, labeled, and fed into a model. It doesn't vanish when you diversify across countries, instruments, and counterparties. Sometimes, it simply hides, waiting for the moment when everyone needs the same exit. Leverage didn't cause the collapse by itself. Math didn't cause it either. What caused it was confidence layered on top of leverage, reinforced by a long stretch of calm that convinced people nothing fundamental could go wrong. Another illusion shattered quietly that year. The belief that markets are always liquid, that there is always a buyer, that prices only move smoothly. Liquidity, it turned out, is not a permanent feature. It's a mood, and moods change fast. The rescue also left behind an uneasy debate. If a private hedge fund could threaten the stability of the entire system, even without taxpayer money involved, what did that say about modern finance? Who was responsible? Who was watching? And how many similar risks were still invisible? Regulators took notes. Banks adjusted rules. Models were tweaked. Stress tests were added. But the deeper problem remained harder to solve. Financial systems don't just fail because of bad design. They fail because people stop imagining failure. What made this story especially unsettling was how quietly it happened. No mass layoffs. No public panic. No live countdown on television. The financial system came within inches of a disorderly collapse. And most people never knew. That silence is part of the danger. Because stories like this don't end. They echo. Every time markets stay calm for too long. Every time returns look too smooth. Every time risk feels solved. This lesson quietly returns, asking to be remembered. The world didn't change after 1998. It just learned, briefly, how close it was to the edge. Long-term capital management didn't fail because the people behind it were stupid. It failed because they were confident, comfortable, and rewarded for being right again and again in a world that hadn't yet changed. The danger wasn't the math. It was the belief that math could replace humility. This story isn't really about one hedge fund, or one meeting room in New York, or one late-night phone call that quietly saved the system. It's about a pattern that repeats whenever markets stay calm for too long. Confidence grows, leverage grows, questions disappear, and risk quietly stacks itself higher and higher, waiting for the moment no one plans for. What makes this story unsettling isn't that the system almost broke. It's that it almost broke without noise, without headlines, without most people ever realizing how close it came. The edge was there. It always is. Finance doesn't collapse when people are scared. It collapses when people feel safe. So the next time returns look smooth, models feel bulletproof, and risk seems solved. Remember this moment. Remember that markets don't fail because of chaos. They fail because of comfort. If you found this story useful, unsettling, or uncomfortably familiar, take a second to like the video, subscribe to the channel, and share it with someone who still believes markets always behave. Because understanding financial history isn't about predicting the next crisis. It's about recognizing the silence before it.